Has the price of oil finally come down enough, down again today, that we can start picking at the oil service plays? Or is it too soon? The whole oil service business is in a tough spot right now. On the one hand, these companies typically benefit from any increase in production. But on the other hand, right now, the world's already awash in oil, and the servicers are getting squeezed because many producers can't afford to pay up for their expertise and equipment at these levels. Long run, this industry needs higher oil prices, but to get there, we either need a dramatic and I think unlikely surge in worldwide growth, or we might need to ratchet back production, which could be bad for business. So how does a good company handle this kind of situation? Consider the case of Patterson-UTI Energy. It's an oil field services company that operates one of the largest fleets of land-based rigs here in the U.S., as well as having a lot of pressure pumping equipment. As the price of crude has pulled back lately, Patterson-UTI stock has gotten slammed. Okay, it's down 30% from its highs. Not unusual for the oil patch, believe me. However, the company hasn't just been sitting on its hands. Back in April, Patterson closed on the acquisition of competitor 77 Energy, and the company's results have already started improving. When they reported in late April, they delivered a smaller than expected earnings loss on higher than anticipated sales, up 13.5% year-over-year. So what do we make of this business going forward? Let's check in with Mark Siegel. He's the chairman of Patterson-UTI Energy. Find out more about how his company's doing and where it's headed. Mr. Siegel, welcome to Mad Money. Good to see you, sir. Have a seat.
Jim, thanks for having us on.
Well, you guys are not sitting idly. You're doing what my friend Rusty Brazil from RBN Energy and we use suggests, which is that you're actually taking advantage of the fact that things have come down. You're buying a competitor and therefore making your company better.
Jim, that's exactly right. We've done a number of transactions when the oil market's been pretty soft. Right. And typically we've done them just as we're coming out of it, and this was just one more of those kinds of acquisitions.
Now, I think you need to explain to people there is something, the technology here. 77 Energy made it so you had more super spec rigs. Now, for the parlance of the conference call, everyone knows what super spec is, but you could tell our viewers why it's important and what is this new kind of drilling technique that's so important.
Well, Jim, the super spec rigs, and we're very proud to have a lot of them, are rigs that are capable of drilling the most complicated and deepest wells. These wells are a mile deep and then 2 miles wide, horizontal.
Right.
And that kind of well requires a very specialized kind of rig that's got all kinds of special capabilities. We're one of the few companies that has a significant amount of them. And by the way, they're pretty well spoken for. There's about 425 of these kind of rigs in the country, and about 90% utilization currently. Okay,
so now people have to understand on Friday the Baker used rig count comes out, and it's always up, and people are always confused because wait a second, oil's not going anywhere. But you yourself have just go the trajectory of how many rigs you were using in the fourth quarter versus first quarter versus now.
Well, Jim, we've seen a very significant increase in our rig count. We've had 12 consecutive months of increases in rig count, despite oil prices, as you say, being a little bit soft. So the reason is that the people who produce oil in the Mid-Continent and the Permian Basin, they figured out how to be economic at these kinds of prices. And for us, on shore, 50 is the new 80. And so, and really, we're kind of in a Goldilocks position. And the Goldilocks position is between $45 and $55 for oil prices. Quite frankly, it's not so good for offshore. It's not so good for international. But it's pretty darn good for people who are in the onshore business in the regions of the Mid-Continent and the Permian.
Well, we should talk about the other business, too, pressure pumping. We know that if you put more sand in, things are better. You're in good shape in that business, too.
That business is real good, Jim. That business, we've seen ourselves, the 77 acquisition allowed us to go from 1 million horsepower to 1,000,005 horsepower. And that was a very significant situation. That ranked us number 5 in terms of total horsepower, maybe higher in some of our...
And that's important, again, because you're drilling deep and then wide.
You're exactly right.
Okay.
And you need that kind of that horsepower to drive the sand through those 2-mile-long laterals. And we've got it. Not everybody does.
Right. Now, people should know that 77 Energy was actually at one point affiliated with Chesapeake.
Right.
Right. And that was built, and that was going to be a big spin-off, but you managed to get it for, I think, a very low price.
Well, thank you for that. We do, too. What happened was, as you know, Chesapeake decided to have their own service company.
Right.
They did that. They took 77 and they spun it out as a separate public company. They put a significant amount of debt on it.
Right.
When the turndown occurred, it was unable to handle its debt, went into bankruptcy, came out of bankruptcy, and we bought it from the shareholders just as it emerged from bankruptcy.
And it's important to point out that you, despite the fact that I think you got a great price, but your balance sheet is really much better than everybody else who's in the service business, almost better than everybody.
Jim, we think having a fortress-like balance sheet really counts. You know, having a 15% debt-to-cap ratio, we think, gives us the ability to grow our business when there are opportunities. and to be able to take advantage of these downturns.
Okay, now, because it is still a downturn, you've got rig margin per day decreasing, but you also, your CEO said in the conference call that you think the margins are bottoming. How's that possible?
Well, the simple answer to that question is as we put more rigs to work, typically prices go up. And we think that that's a long-term trend for us that's going to really help us to increase our margins at the rig level.
Okay, if 50 is the new 80, then it sounds like 50 is what we better get used to. You do not, I mean, the forward curve out 5 years says that oil's going to be at 50. It would not surprise you to see oil at 50 for some time, right?
No, it wouldn't surprise me. And, you know, if it's between 45 and 55, we're going to do just fine.
Well, that's what we're looking for, companies that do that, and a lot of the companies that are your clients have figured that out, too. And that's why there's some buys there. I just wish that people recognize it. That's Mark Siegels, the chairman of Patterson-UTI Energy, PTEN, that's made a lot of right moves in this downturn. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.